Hey, welcome back everybody. You're tuning in to howtoplaystock.com. Today's Friday, May 12th, 2017. Hope you guys are having a good day. Um, Definitely ready for the weekend here. For today's video though, I just wanted to cover what's happened over the past week and talk about money velocity. Alright. Over the last week, we've had the earnings reports come out. You've had Donald Trump, who just got rid of Comey, who's the director of the FBI. So there's been some big news out there, and some of that has had an effect on the markets, especially when it comes to earnings reports. Earnings for corporations that are coming out right now are abysmal, to say the least. I mean, nobody's earning anything, and I think part of that is due to the fact of money velocity. Now, if you're not familiar with what money velocity is, it's basically the rate at which money switches hands. Okay, do you understand what I'm saying here? So basically, if you have somebody, let's say I have $10, right? Throughout the day, I might exchange that $10. I might go to the convenience store and buy, say, a 7-Up or a Dr. Pepper or something like that. That's a transaction, okay? And that transaction counts towards the money velocity. So I'll get change back for that product that I buy. Then I might go get a taxi cab, if I'm living in New York or someplace like that, and take that to work. That's another transaction that takes place, and that accounts for money velocity. So money velocity is basically just the measurement in which transactions of cash switches hands throughout the economy. Now, why this is important is because if money velocity starts slowing down, that means people aren't spending as much, and that has an effect on your consumer spending. If your consumer spending isn't there, then a lot of your retail and major corporations out there on the stock market are going to start suffering when it comes to earnings reports. You understand what I'm saying here? So basically what's happening is we've got consecutive quarters where earnings are going down for companies and they're not profiting any longer. And a lot of that is due to the fact that money velocity is starting to slow down. Now I'm going to show you a chart here in the next portion of this video, and I'm going to prove to you just how much money velocity is slowing down. We're going to compare that to the M2 base money supply. Now what is M2 base money? That would be the expansion of credit. All right. So when the Federal Reserve and monetary policy is being talked about in regards to the economy and interest rates and stuff like that, a lot of what they're looking at is the expansion of credit, just how earnings are doing on the major markets, stuff of that nature. So that's how they make a lot of their decisions from the Federal Reserve. Now, I'm not in the Federal Reserve Bank. They tried to hire me at one point when I was in the IT realm, so I was looking at their company and taking a deep dive into just what they do before I even went in for an interview for their information security side of things. But I didn't take the job, so I'm not an insider on the Fed. I couldn't tell you what they do on a day-to-day basis, but I know just in general that's the kind of stuff that they look at when it comes to deciding what they want to do with monetary policy, interest rates, stuff of that nature. So remember, money velocity is the rate at which cash transactions are taking place and switching hands on a daily basis, and that if you compare that to the expansion of credit and M2 base money supply, you can get a good indicator as to whether or not the economy is growing or we're going into a recession. So stick around, keep watching. I'm going to show you in the next portion of this video where we are right now with money velocity versus the M2 base money supply. Okay, so what I'm looking at here is a website from stlouisfed.org. We're looking at the money velocity of M2 money. Okay, now this is the expansion of credit. So we're looking at the money velocity, basically, of credit, in which transactions are taking place through time. Now this goes all the way back to 1959, and as you can see here, we're all the way over here in 2017, and we're at the lowest point on money velocity of M2 money or credit in over, I'd say 40, 50 years. So that's not looking too good. And as you can see, I mean, look right over here in 2006. It had already taken a dive in 2000, jumped back up a little in 2006, and then it just falls off a cliff. So I'm going to just briefly summarize this article here for you by the Federal Reserve of St. Louis. Now, the velocity of money is the frequency at which one unit of currency is used to purchase domestically produced goods and services within a given time period. So in other words, it is the number of times $1 is spent to buy goods and services per unit of time. If the velocity of money is increasing, then more transactions are occurring between individuals in an economy. So like I was saying, the economy, if you got a money velocity that's increasing, your economy's growing. If it's decreasing, your economy's contracting and you're going into a recession. Now you might notice that with earnings reports that have came out over the past like 7 or 8 quarters, they've just been lower and lower and lower. And the Federal Reserve has been pumping money back into the markets. Now, they haven't been doing this directly. They've been doing it indirectly. And they've been doing that by giving companies money so that they can buy back their own shares of their own stock. Okay, I don't know if you guys know that, but that's what they've been doing through some of their quantitative easing, which was the increase of credit and printing money. Now, that doesn't necessarily increase money velocity. And you might hear Alan Greenspan talk about this in some of his hearings with Congress back when he was chair of the Fed. He specifically said that they could control the amount of credit that was being expanded, but they could not control consumer spending and people actually spending money and money velocity. In other words, they can't control purchasing power. And because when they expand credit like this and you get a whole bunch of currency flooding the market, well, the value of your currency becomes worth less. You get prices increasing through inflation because of it, and people don't spend. Okay, instead they save money, and that affects your money velocity. So the frequency of currency exchange can be used to determine the velocity of a given component of the money supply, providing some insight into whether consumers and businesses are saving or spending their money. So you understand what I'm saying here? It goes hand in hand. There are several components of the money supply. You got M1, M2, and MZM, which is M3. And that's no longer being tracked by the Federal Reserve. These components are arranged on a spectrum of narrowest to broadest. Consider M1 the narrowest component. M1 is the money supply of currency in circulation. This would be notes, coins, traveler's checks, demand deposits, checkable deposits, stuff like that. Now, a decreasing velocity of M1 might indicate fewer short-term consumption transactions are taking place. We can think of shorter-term transactions as consumption we might make on an everyday basis. Now, the broader M2 component includes M1, in addition to savings deposits, certificate of deposits less than $100,000, and money market deposits for individuals. So comparing the velocities of M1 and M2 provides some insight into how quickly the economy is spending and how quickly it is saving. So if you got people saving, you can go back and look at Weimar Germany back in World War I, around 1918. They saw firsthand just how this works. Okay, so people were saving money while the central bank was printing money. They went into a deflationary period, and then it turned around and went into a hyperinflation shortly thereafter, and the purchasing power completely got destroyed. The central banks, again, like Alan Greenspan was saying, they didn't have any control over that. They couldn't control it. Therefore, people just simply took their cash in wheelbarrows, took it down to the markets, and just dumped it on the streets because it was worthless. So these are things you need to pay attention to if you're looking at stocks and you want to invest. That's what my channel is about, is covering information like this for you so you can better understand components of the economy and how it works, and you can make better investment decisions. So if you haven't subscribed to the channel, go ahead and do so, because I cover a lot of different aspects of investing. And if you're somebody who's looking at stocks right now, I would ask you the question, why would you want to invest in stocks if you have money velocity that's at all-time lows and haven't been this low since past 1959? Why would you want to invest in stocks when you have the S&P 500 at a P/E ratio of about 26 or 27? Now, fair value for stocks is around 10 to 14. So that means, everything's massively overinflated. Part of that's due to the fact that the Fed, like I was saying, has lent money to these corporations so that they can buy back their own shares. So it doesn't make sense why you'd want to actually get in on stocks right now, because it's all artificial. There's no floor underneath it. So when this thing comes falling down, the question you have to ask is, how far is it going to come down? Well, without a floor or any support underneath it, you could be possibly looking at a free fall in the stock market. And who knows what the Fed would do in order to stop that. My guess would be that they're just going to fire up the print presses, because they can't really do anything with interest rates right now. Okay, they could possibly go into something called NIRP, which is your negative interest rate policy, which Europe already tried and failed miserably at. And if they were to do something like that, well, it's going to affect your bonds and fixed income investments. And if you start playing around with those and you go into negative interest rates, people are going to start dumping the U.S. Treasury bonds that they already carry. So I just don't see any way. I just don't see any way out of it at this point. And if you're in stocks, I would say get out of the way. Just from what I'm covering here, just get out of the way, because you do not have to participate in the next recession. And to be quite honest with you, I think we're already there, because if you look at what the technical indicators are for a recession, it's 2 consecutive quarters of lower earnings. Well, if you look at the P/E ratios and the earnings reports that have been coming out for the last 7 to 8 quarters, they're just getting lower and lower and lower. And a lot of that is because of the money velocity. That's the underlying cause of most of what's going on right now. So it's something to pay attention to. It's something to look at, along with the price to earnings. When you can get a better idea of what's going on behind the scenes like this, you can make better investment decisions, like I was saying. So if you haven't subscribed to the channel, go ahead and subscribe to the channel, because I'll be covering more topics like this in the future, and giving you updates on the stock market and where you can put money, because wealth is merely transferred. It's not destroyed. Okay? So with that in mind, there's still places and opportunities to put money so you can get higher returns as an investor. And stocks are just one of those. Right now, though, stocks are not a good place to put your money. And you do not have to participate in that if you're doing your own type of investing outside your 401k. I've covered that in another video as well, why you want to invest and start taking a do-it-yourself approach rather than investing in a 401k. So go ahead and subscribe to the channel. These are today's investors investing tips. I hope you enjoyed the video and the information being presented here. And remember, guys, income is the outcome, okay? I hope you guys have a good weekend, and I will talk to you later.